Hello and welcome. You're with us here on Business Today. I'm Aabha Bakaya. Joining me today, Deepak Jasani of HDFC Securities. Deepak, great to have you with us, especially on a day when markets definitely need some kind of insight. The plunge post the news around SVB Bank and concerns once again of really what's happening in the US and the strength of the banking system there. To what extent do you feel this is really a knee-jerk sentimental reaction? Is there a deeper, larger concern that we could see contagion?
Yeah, good afternoon. The banking crisis or the contagion, as you would expect in the US, will definitely impact sentiments, especially in the developed economies. And we will also see the collateral damage in terms of sentiment impact on our equity market, at least, if not on the banking system or the bond markets. So people have the memories of Lehman Brothers and all fresh in their mind. So there is a doubt whether we will see Lehman Part 2 this time around. Last time it was the case of a lot of bad debts on their books. This time it is the case of MTM losses on their bond portfolios. So although the reason for the losses may be different, but having said that, the losses on the books in most cases may still be quite large. And in case the news flow, the negative news flow does not cease soon enough, then we could see some more downside in the markets globally and also in India.
Okay. In addition, we've got, the Fed decision coming up shortly. What are your anticipations there? How much could that help? Or any commentary there could be significant as well in soothing the markets. Do you feel we are already perhaps also awaiting some kind of indication there? Markets today in free fall, so clearly we're not factoring in any good news right now. But what could we potentially hear from the Fed that would help to soothe the markets?
Yeah, so there are different expectations on the street. Now, one expectation is that 50 basis point rate hike is now out of question. So now we are dealing with two outcomes. One is a 25 basis point rate hike, and the other is no rate hike at all. So one of the large investment banks in the US is tilting towards the second view. In case US Fed ultimately opts for no rate hike, then it would be a good signal to the markets generally. If they opt for a 25 basis point rate hike, then still the reason or the trigger for the recent fall will remain alive, and we will still see a lot of banks coming into trouble. So I think a no rate hike kind of a situation out of the US Fed meet will be welcomed by all at this point of time.
Okay. Well, we've seen, Goldman in particular, scrap their views on a potential hike coming in from the Fed. We've also seen a massive volatility when it comes to crude, for instance, as we've seen everyone turn to trying to restore some stability to equities post this entire SVB mess that's unfolded. In addition to that, we've also got the dollar lower, tailwind now for commodities, just when we'd started to see that pick up, in energy prices. How much of an impact do you see this having as well? Because just looking at asset classes across and the implications on a larger scale of this fallout.
So, first things first, we have seen the past linkages between interest rates, inflation, equity markets, commodity prices, etc. Whatever we were taught or whatever we learned in the past is now no longer applicable, mainly because of the QE. Now, QE disrupted all these linkages to quite a large extent. So, whatever we saw in the past may not necessarily happen in the future. Now, having said that, in case we are at a situation where the rate hikes stop, from that point of view, US dollar may start to weaken a bit. US dollar will weaken, leading to commodity prices upturn. But now, for commodity prices to remain uppish, we need the economic growth to pick up momentum. Now, whether that happens soon enough, we'll have to watch out very carefully. China has reopened recently, so there is some hope about the economic growth momentum being picked up. But we have to watch the European and the US markets, especially for growth returning soon there. So in case such a thing happens, then of course commodity prices can also keep rising.
So it's interesting because I was just going to ask you, that's the next question. Given this current scenario with regards to rates and inflation, are we now going to start to see the squeeze? Till now, we haven't seen any impact on demand. But what do you foresee, and how are you looking at your strategy right now?
So as far as India is concerned, we are a domestic focused economy. So in that sense, a large portion of our GDP comes from within. We'll have to watch out for demand triggers or demand issues at the local level. Of course, the global market is also important as far as the exports are concerned. Looking at the local markets, I think demand from the rural areas is a little sluggish, has remained sluggish for some time. There was hope of a revival in that demand. But I think the El Nino fear on the one hand, on the second hand, the abnormal weather we are seeing lately may impact the production of agri crops in the Rabi and the Kharif harvest. In case that happens, then the rural demand revival will get further postponed. In the urban areas also, we have started to see a little bit of down trading lately. So broadly, I think demand conditions are a little weak within India. We need this fear of El Nino to get out of the way. Then probably the sentiment will improve and we will see more spending across the board. As far as the global demand is concerned, I think a lot will depend on the interest rate trajectory. In case the interest rates peak out soon and start to reverse, then we will see demand reviving across the board. Till that time, we will have a lot of other worries on our plate, so that demand only for the essentials will continue. For the discretionary items, they may get postponed.
It's interesting because the picture is changing very fast this year. We started on a fairly positive note, seemed to be, robust, but now it looks like there are just a lot of moving pieces and it's getting increasingly difficult to plan one strategy. What would you suggest? Because in the immediate term, at least, market men are concerned about further weakness. Are you looking at that as a time to get into certain pockets? Are you sitting on the sidelines? What would you suggest to investors?
So the first advice to the investors will always be to keep reviewing your portfolios and sort of adjust your asset allocation. When the markets were at a peak a couple of months back, most portfolios saw their equity weightages rising. In such a circumstances, it was natural to take some profits on the table, raise some cash, and wait on the sidelines. Now, if you have not done that, even now is a good time in case you have seen your stocks multiply, some of your stocks multiply and not having fallen much. Okay. So, asset allocation and portfolio reviews is a must at any point of time, whether you are in a bull market or a bear market. Apart from that, I think technically speaking, we are in a downward sloping channel. So levels of 16,700 or 800 seem likely soon enough. So around those levels, maybe there will be a opportunity for a short-term trade or a short-term investment over a couple of months. One can look at participating in that. For long investments, I think one have to still wait. Trading opportunities, of course, abound on an everyday basis, but most people are long in the trading systems, and you will have to learn to sort of go short and long depending on the existing circumstances.
Okay, fair enough. What are the pockets also that you're looking at? I mean, first, let me dissect between the the heavyweights or the frontline names versus, of course, the broader markets. And secondly, would you be looking thematically, or sticking to stock-specific picks?
Broadly, I think stock specific will help going forward. But if you talk about sectors or themes which can do well over the next 1 or 2 quarters, I think we are looking at capital goods as a sector. Apart from that, power could also do well in an era where we are expecting scorching summer ahead. And oil and gas and auto are the next two sectors which we think may do well. For the time being, defensives, including IT and FMCG, may not do well. So one can stay away from them for some time and time their entry appropriately at the low level.
Okay, fair enough. Did you mention auto just now? Because I'm curious, that's discretionary. We've also seen it so sluggish, only just about picking up in some pockets. What's making you bullish on that particular front?
Auto we still have a lot of waiting list on a lot of models across the auto manufacturers is number one. Number two, two-wheelers as a space is a mature space, so we are not so bullish on the two-wheeler space. CVs, we are seeing pickup in their sales. There may be a few months here or there where the growth may not come, but on a broader basis, I think CVs and passenger vehicles can continue to do well for the next few months. Of course, passenger vehicles are part of discretionary, but I think it is more aspirational rather than discretionary. People who have wealth, people who have stable sources of income would like to graduate from one car to a higher level car, or maybe from a two-wheeler to a motor car. And that process may continue for some more time.
Okay. The financials are also taking a brunt today. While we have seen a resounding number of buy calls largely for, particularly private sector banks, and of course, there's been a huge chunk of the market also interested in some of the deep value PSU names. Financials have been taking a hit at any news of uncertainty, whether it was the Adani fiasco, whether today it's at the SVB crash all the way on foreign shores, but that's the segment of the market that's taking the biggest hit. Any concerns there?
Bankings, I think, are high betas, high index weight stocks. So whenever the FIIs are bullish or bearish on the Indian market, I think banks tend to do well or not do well. So irrespective of how the banking industry is doing, or whatever is the credit growth, whatever is the NPA trajectory, I think a lot depends on the institutional flows. So currently we are seeing some weakness in the banks. Now that is more due to the FI activity or the institutional activity rather than the individual merits or demerits of individual banks. Banks may the key 2 or 3 triggers in the banks are still applicable or still alive. Credit growth continues to be good. NPAs are also under control and coming down. And NIMs are also protected at this point of time. Of course, competition keeps on rising, but players have learned to sort of focus on certain specific niches in terms of areas, regions, or products, and trying to exploit their own competencies in these respective areas.
All right, fair enough. In terms of, I know you won't speak on, individual stocks, but in terms of some of the key large caps that may have run up tremendously recently, would you still go for, let's say, an ITC, even a Reliance at current levels, or would you prefer to go for the names where we've seen a bit of a sell-off and that there is room for fair evaluation?
I think where the market sentiments continue to be a little weak, it would be fair to stick to the stronger stocks for the time being. The weaker stocks have seen some sell-off and may continue to see sell-off in case the sentiments turn adverse. So if you want to perforce be a buyer in this market, then it's a good idea to stick to stronger stocks which haven't fallen much or which have fallen much less in the market, rather than try to bottom fish the stocks which have fallen quite a bit.
All right. All right, Deepak, thank you so much for joining us and taking us through your current stance on markets and all the key developments. Great having you with us.
My pleasure.
If you like the video, do like, comment, share and subscribe.